It's time for the David Eldridge Financial Literacy Show, the show that helps you understand the long list of financial strategies available to you and how they work. Because financial and retirement planning doesn't have to be complicated. Are you ready to break through the financial clutter and confusion? Here's your host, David Eldridge.
This is David Eldridge, and you're listening to the David Eldridge Financial Literacy Show. On today's episode, talk a little about market volatility and what should I do. And if you stick with me to the end, I do have a special offer for new prospects so that we can have a conversation after we talk today. So recently, over the past couple weeks, there has been a lot of up and down in the market, some significant down days, and recently some days where significantly down during the day, but the market rallies back on that same particular day. So what should you do? First off, I want to talk about what you shouldn't do. Things to avoid are sometimes some of the things that are more important to do. So number one, don't look at your portfolio every day. I know that sounds, easier said than done, but I tell clients all of the time, it's okay to turn off the TV. You're going to hear about it, even if you don't want to hear about it, from friends, family, social media, water cooler talk if you're headed into the office. But not looking at it all of the time will allow you to focus on what's important. Keeping your mind on, exercising, go and take a walk, which I will joke with clients all of the time. So looking at it every day is not going to be healthy, especially when it's days where there's a lot of up and down, because then that triggers emotions, and it could potentially cause you to act irrationally versus making a logical decision, which could significantly impact your long-term financial goals and financial plans. Next one, number two, don't get caught up in that moment. Now, this is easy if you're not looking at it every day, if you're not turning on, the financial news either, but really reminding yourself that it's normal for markets to go up and go down. It's normal to have 2 corrections on average a year of about 10%. That's very normal, and we're coming out of a period where we haven't had that recently, other than March and April of 2020, when COVID kind of shut down the economy significantly in a very short period of time, and then we've come back from that. But really focusing on, again, those long-term goals. If you're still working, we still have time where we're waiting until we're getting ready to retire. And then even in retirement, a very long period of time, hopefully, that we're going to be enjoying retirement in those activities that we're looking to do. So making sound, rational decisions only when needed and necessary. So sometimes the best thing to do is nothing. And that's nothing new that you haven't heard before. The third one here, and I've seen this before too, I'm going to wait until the market is a little more stable. And I'll share a story. I was working I've been in the industry for a little over 11 years. And probably 4 or 5 years ago, when we had some significant downturn in 2016, there was a lot of volatility at that time. I would talk with prospects and clients at the firm I was with at the time, and some people were still on the sidelines from 2008, 2009. So not only had they pulled money out when the market was down during that particular period, they missed out on all of those positive gains that occurred by staying in, because a lot of them, unfortunately, made emotional, quick, rash decisions, and they didn't enter back into the market. Fast forward to March of 2020 and spring of 2020, when COVID really shut down the market and shut down the economy very rapidly. You will talk with people today, and I hear some now and again that they got out during that period, so they realized the loss, 30, 40, 50%, depending on what they were invested in, and they've stayed out. They missed out on the last almost 2 years that we're at of growth and gains by making emotional decisions that are not always logical and a lot of times are very irrational. It will help you feel good for a short period of time, but you want to make sure that the resources that you do have last for retirement so that you can enjoy those years, because that's what you're saving for. That's why you're investing, so that you can enjoy that lifestyle that you are looking to do in retirement. So those are the 3 things that you want to avoid, the things not to do. Well, what do you want to do when there is market volatility? How can you take advantage of that when it is occurring? First off, if you're investing on a regular basis, each paycheck into your 401k or 403b, or even into your IRA or into some type of investment account, keep doing that. Don't turn that off unless you've had some significant life event that you need to discuss with a financial planner that could change your goals. Otherwise, take advantage of the opportunity that, okay, the market is down, and we'll just talk stocks for instance. Stocks are cheaper than they were, so we're going to buy them on sale. Who doesn't like going to the store and getting something on sale? No one likes to pay full price. That will allow you to buy more shares of those stocks or funds and allow that to grow back over time as the market course corrects and recovers over time. The other thing to do is, if you have the ability, you've had some money sitting on the sidelines, you've had some cash sitting there kind of waiting to decide what you want to do, looking to invest, it's a potential opportunity for you to take advantage of that downturn, get in while things are on sale, relatively speaking, based off of a recent market, and take advantage of that to allow those resources to grow, especially if they're resources for the long term, 5, 10, 15, 20, 30 years down the road, so you can allow that money to grow. And of course, seeking professional guidance, seeking help. So speaking with your financial planner, or speaking with a financial planner like myself, to really help you understand, how does this impact your overall situation? Does it really impact it, or doesn't it? And really being here as that sounding board, so that way you're not making irrational decisions. I joke with clients that most of the time I put on my psychologist hat, if you will, so that way we can really talk through the emotional aspects of investing and making sure that we're keeping in mind the long term versus what's happening today, what's happening this week, what's happening this month, what's happening even this year, so that we make sure that we reach those goals in the long run. And as I promised, sticking with me through the end, for today's listeners, want to offer a complimentary consultations. So that way, if you do have questions about your financial planning, if the market volatility recently is causing you some angst, maybe losing some sleep at night, or just some uneasiness, please reach out to me, because I'm here to listen. I want to have that conversation with you, help you navigate the twists and turns that you may be experiencing. So to take advantage of that, reach out to me directly at the office at 602-500-7726. You can also email me. It's david@eldridgecapitalgroup.com. Or go directly to my website, eldridgecapitalgroup.com, and you can schedule a consultation directly there as well. I want to thank you for listening today, and continuing to subscribe to the podcast and share via whatever platform you choose to subscribe to podcasts, whether that's Apple, Google, Amazon, Spotify. Have a great day.
Thank you for listening to the David Eldridge Financial Literacy Show with your host, David Eldridge. If you have questions for David, you can reach him at www.davidel.com. david.eldridgecapitalgroup.com or by calling his office at 602-500-7726, or feel free to send him an email at david@eldridgecapitalgroup.com.